What's going on, YouTube? This is your boy Nick with NIC Pips. Thanks for clicking on my video. If you clicked on it, that means you're here to learn about Forex. Forex is a phenomenal industry that has changed my life. To hear my story, click on the video below. I'm gonna link it there. I tell my whole story and how I got started and funny ways of how I learned along this journey. So thank you for checking it out. Again, I'm gonna share some valuable information with you. Enjoy the video. Okay, first we're gonna start off by reviewing the basics of Forex. And so the biggest thing I think you need to know is, what is a pip? So let's go ahead and go over to our MDS chat. This is our resources chat. We have a lot of resources for our team members. So I'm gonna go ahead and check out a couple of photos. So one I'm gonna look at is the one around pips. Here we go. So what is a pip? A pip is a point in percentage. So it's the way that we in Forex measure price distances. So when price goes from one point to another, let's say from $1 to $1.50, those differences or movements in price are measured in pips, kind of like miles per hour when you're in a car. All right, so same thing. So 1 micro lot is equivalent to a 0.01 lot size. So that's going to be similar to 10 cents per pip. Okay, a mini lot as an order is going to be a 0.10 lot size, which is equivalent to $1 per pip. So 1 pip would be equivalent to $1 US. Now this is if you're trading USD pairs. When we get further into the trading, if you're trading things like GBP pairs or Australian pairs, there may be a little variance there, but this is just to give you a basic understanding of how pips work. All right, your order size, aka your lot, so 1 standard lot is equivalent to 1 pip equaling $10 per pip. So this is how you can measure your risk, aka how much money you would lose, and your reward, aka how much money you could profit when you trade in Forex. So let's go ahead and look at another graphic. Going a little deeper into pips. I talked about lots. So lots are going to be your order size. Whenever you place a trade in Forex, you're actually placing an order through your broker for a specific amount of currency. So here go the sizes of the lots. So like I said, a mini lot, a micro lot is what we talked about. All right, is 1,000 units. All right, and so when it talks about the volume, this is what you would enter into your trading application to place your order size. So a 0.01, we call them lot, is going to be equivalent to 10 cents per pip. A mini lot, which is 10,000 units, which is equivalent to a 0.10 volume, which is going to be $1 per pip. And then a standard lot, this is the big boys right here. When you get up to the standard lots, that's when you're trading with the big boys. That's 100,000 units, all right, which is equivalent to a 1.0 volume, aka lot size, and that's going to be $10 per pip. Whenever you place an order, you have to know what your lot size is going to be. So that means what's going to be the quantity or units that you're going to order, and then also what's going to be the volume. That's going to be how much you're going to be risking per pip. So let's go ahead and go on to the next thing. So outside of that, let's talk about order types. So whenever you place an order, there's several types of orders you can place. The most common one is going to be a market execution. Market execution simply means that when you hit the button buy or sell on your trading platform, that means that you're asking a broker to instantly or execute your order on the spot. So whatever price is, when you click that button, is going to be the price that you enter in on that trade. But they also have what they call limit orders. Limit orders, buy stops, sell stops, buy limits, and sell limits. So as you can see on the screen, a buy stop just simply means that you expect the price to go from below, all right, so if the price is down low, and you're going to have your buy stop order above that price. So if price comes up and passes through that buy stop, it's going to enter you into a buy, because you're expecting price to continue up. Same thing with a sell stop. Your price is going to be up here, up high, and you're expecting the price to drop down below a certain level. So you put your sell stop at this level, and once price crosses through it and comes down, that's going to enter you into the trade or execute your order. Now, buy limits and sell limits are a little tricky. So on buy limits, price is up high and you're expecting the price to dip down to a certain level and then come back up. It's called a buy limit. So what you would do is you would place your order below current price, because you're expecting the price to dip down to that level and then come right back up. Opposite with the sell limit. You're expecting price, with it being low, you're expecting the price to rise to a certain level and then drop back down, and you want to place your limit order above current price because you're expecting the price to come up, hit that ceiling, all right, or that resistance, and then drop back down. Same thing with a buy limit. Price is above current price, price is right here at the top, and you're expecting price to drop down and hit a floor, aka resistance, support, and then come back up. All right, so those are different order types. So you got the market execution and you got the pending orders, aka buy stops, sell stops, buy limits, sell limits. So if you have any questions about those items, guys, drop them in the comments below. I'll be taking a look at the comments. All right, so those are order sizes. That's going to be lot sizes. We talked about that. Now let's talk about just let's look at it in real world, right? So let's go ahead and look at it on the chart. So here's a US oil trade that I took. Now I'm trading on the day chart. So that means each one of these candlesticks is what they're called, Chinese candlesticks. They represent the change in price over this particular time frame, which is a day. So I have a little unique setup, but I can change that literally by going here, changing my color theme, and voila. Now I got a whole different color scheme, right? So let me go with this one. Red and green is the color that most people know. So green meaning the price started lower and went higher. Red meaning the price started higher and dropped lower, aka went in a sell. As you can see right here, I recognize this level of support, right? I call it support because it's a floor. Price had trouble getting through this floor. So as we can see right here, price came up, came back down, respected this particular support, and then came back up. When it came back to the same level again, I'm expecting it to do the same thing because again, this has shown to be a strong level of support. So when price came down and it failed, look, it reached way down here. This particular wick shows you that the price at one point came all the way down here and then came back up and settled right there at our support line. All right, this green bar is the price tried to come up, as you can see, but then that next day the price came back down close to our support line and respected that support line again. So in my mind, that is a great spot to place a buy order. So of course, right here on this candle, during this day candle, I placed me a buy order and I put my stop loss down here just below this reach down here to try to break lower. I put my stop loss below that because if the price comes and breaks down this level and comes down further, that means that price may be continuing the downward motion and I want to get out of my buy order, because if the price is dropping and I'm in a buy, I'm losing money. So in this example, as you guys can see, that particular stop loss would have been somewhere around 180 pips or so. But look at this, I got into the order. The price went down just a little bit, so it went about 117 pips in the drawdown, which is no problem. Drawdown is a part of trading. It's gonna happen. If you're thinking that you're gonna trade, you're gonna instantly hit the button and be making money. That could happen sometimes, but a lot of times you're gonna deal with what's called drawdown or pullbacks. So that's what this was. This was a little bit of drawdown. As you can see, eventually the price went up over several days, and as you can see, this is where current price is. All right, where this blue line is. And so if you look at right here what current price is as of December the 31st, the last day trading was available because today is the 1st of 2020 and the markets are closed. But as you can see, 56 days later and the price is up here at this level. So that means that that's 882 pips worth of change, as we can see right here by the number in this particular readout. So that's 882 pips worth of change in price. So I'm going to put a screenshot up of what that looks like in the trading application, and as you guys can see, I got in at a 0.05 lot size, which is equivalent to 50 cents per pip. Okay, that's the simple math for that. Now as you can see, I paid some swap fees because I held it over several days. That's the price that you pay when you hold your order over from day to day. All right, but I'm not worried about that because again, out of my 882 pips, as you can see, it was a very small amount versus what I actually am winning at the moment. I say I'm winning because I have not exited this trade yet. Now, what I will do is that I'm going to move my stop loss up. So that way my stop loss is not way down here. I'm going to move my stop loss up to a level kind of similar to like right here. So that way, if the market decides to pull back just a little bit and then goes back up to another level, like it did right here in this zone, as you can see price was coming up. Then it had this little bit of a pullback, but then price continued up. All right. And then right here, it had a little bit of a pullback, but then price continued up. So for me, this is what I call trailing my stop manually. Either way it goes, I'm going to cash out with profit, but this takes great patience. Again, I've been in this trade for a couple of months now. All right. Now that's my trading style. You may be a scalper where you get in and out of a trade in an hour or so, or even minutes. All right. You may be an intraday trader where you get out of a trade in a couple of hours, or you may be a swing trader or a positional trader like I am, where I may be in a trade for several days or maybe even several weeks, or even at sometimes several months, as you can see in this example right here. But again, that's the basics of how you place trades in the foreign exchange market. You look for your setups, you place your orders, and how you actually count your profit through the pips, as I showed you in the example. So let me show you one more thing. Let me show you the power of compound interest. So this is what's great about Forex. All right, so in this particular example, guys, let me go back and look at it. Let me show you guys this. It's called your risk to reward, right? So in this example, let me pull up my tool. All right, this is my positional tool. So let's say, hypothetically speaking, I got in right here. So if I put my stop loss right there where it is, and then right here, when it comes to my take profit, or where I'm at right now, as you can see right here, it shows you my risk to reward ratio is 4.7. That means for my one amount of my risk, I'm gaining 4.7 times that. So that's an excellent risk to reward ratio. So we focus on what we call high probability trades. Again, this confirmation of this support line being strong right here gave me the confidence to take this trade right here and to expect price to continue up. Because as we see, when price came down to this area, we got 1, 2, 3, 4 straight days of bullish momentum, aka of the price rising. So when price came back to this area, I expected the same thing to happen. Now, could I have lost this trade? Yes, I would have lost 187 pips. But over time and with proper risk management, just like I showed you on the screen, for my 1 unit that I risk, I made 4.5 units. So if I lose 1 trade and win 1, I'm still up 3 times what I risk, because every time I place a trade, I risk the same percentage. So let me show you what that looks like. So this is our spreadsheet that we use in our group millionaire withdrawal plan. So as you can see, some advice here on what type of risk that you should take. Everybody's going to be different as far as their account and their risk tolerance level. You do what works for you, but we give you suggestions. So let's go over to the daily. So let's say you have a $300 account and you're risking 3% per trade, which is high. I'm gonna be honest, a lot of professional traders risk somewhere around 1 to 2%. But as I showed you guys, I risked 3%, right? But my reward was 4 times that. So in that example, I would have risked 3% and made 12%. All right, well, 12 and some change, right? Because it was 4.7 times my risk. But let's just say I do 1 to 1 and I grow my account by 3% per day. As you can see right here, day 1, 3% of my $300 account was $9. So if I make $9 on that day, cool, I make my goal. But if I do that consistently over time for 60 days, that $300 account turns to $17.16. Now you may say that that's not a whole lot of money, but it really is if you think about it. Over time, that's going to compound. That's the power of compound interest. So after 60 days, we're at $17.16, right? So let's go ahead and put that $17.16 in here at the top. All right, and we do the same 3%, the same strategy, the same trades as far as your setups. Consistently, on average, if you get 3% per day, so another 60 days go by. So that's 120 days. Now that $300 is $9,815. So let's go another 60 days. So that was 9815. So again, that same 3%. Okay, after another 60 days. So now we're at 180 days, right? So here we go. Now that $300 is at $56,000. So that's an example of how compound interest works and how it can work in your favor. How slow and steady is how you want to go. A lot of people that get into this industry, they want to jump in and do that same thing that took 180 days, 180 trading days. So after 180 trading days, your $300 account is now at 52 grand. Well, see, the problem is a lot of people want to do that exact same thing, but they want to do it in 1 week or in 1 month. Okay, and then they over leverage or over risk on their account. So if they have a losing streak where they lose 4 trades in a row, now their account is drawn down 60% or something ridiculous like that. As opposed to like me, if I have a losing streak and I'm losing 3% a trade, if I lose 4 days straight, I'm only down 12%. But I'm not tripping because my risk reward on my trades, when I hit, my reward is always going to be at least 2 to 3 times more my risk. So if I go on a 3 trade losing streak and I hit just 1, I'm going to be back at least break even. If I lose 3 and I win 2, I'm up. And that's the power of making sure that you follow this right here, risk to reward ratio. That is very key. A lot of times we are too focused on the reward and not considering the risk. You should always consider the risk in Forex because you're not guaranteed to win every trade. It's all about probability. And so you want to look at your trade setups, right? Let's go back to my trade setup. And you want to look for high probability trades. How do you look for high probability trades? You be patient. You wait. This particular price point happened on August of 2019. I didn't enter until it got all the way back over to this area on October. That's several months later. Okay, now this is an extreme example because again, I'm trading on the day chart. All right, could I have taken some trades in between this? Yes. Okay, like right here, we have a level of support right here where this particular area was respected here and it was respected there, right? But no, I want to come down here to this big low because again, price came from way up here and came down. So high probability trades is what it's all about when it comes to low risk, high reward. Wow, that information was phenomenal, man. If you guys enjoyed the information, go ahead and give me a like. And do me a favor, drop a comment below. What other kind of videos would you like to hear? If you look at it, man, Forex is a way to earn some serious cash, but you got to learn this skill set. How do you learn this skill set? Patience, diligence, and consistency. You got to get into the charts. You got to get into the trades, and you got to get that experience, man. Are you going to win every trade? No. But if you learn how to minimize your risk and maximize your reward, the sky's the limit. Thank you guys for checking out the video. Don't forget to subscribe before you go. Also, drop a like if you enjoyed the content, and I'll see you guys on the next video. Peace.
Yeah, Bankroll, oh, what up, man? Smooth. I had a dream, I had 1,000 pip trade with a standard lot size from the daily high. I took it down like a post I'm ashamed of. Ain't had a pay stub since 2005. We all in this together.